Good day, everybody. It's Greg Schnell, and I am here with Martin Pring for Martin's monthly roundup. He goes through a ton of big charts, takes a great perspective that's a little wider than most of us look at, and for that reason, Martin's charts really do help lend a different perspective on the market. And Martin, are you there with me?
I certainly am, Greg, and welcome back to Calgary.
Yeah, I got all the way back from nice sunny golf weather and came back to a snowstorm. So the golf course is closed till Friday, I think. So anyway, it's kind of funny weather here, but yeah, things are going okay. So what have you got for us this week?
Well, we've got a few things. Let's just go through the summary and then get into the main part of the presentation. First thing, we see a few green shoots are starting to signal an end to the economic slowdown. We were in a position a couple of months ago where we didn't know whether the slowdown was going to morph into a recession or whether it was going to end and in terms of a renewed recovery. And it seems the latter is what we're about to see. Although, as I say here, it's green shoots. So it doesn't mean to say that it's we need to bet the mortgage on it, but it's the right sign. We're seeing the right kind of things happening if we expect to see the end of the slowdown and avoid the recession. And as a result, we've got more long-term US stock markets indicators that have gone bullish, and we'll get into those. Last month, we saw that our my stock barometer had gone bullish, which is an overall consensus indicator, and that's now being supported by several other indicators, which we'll get into. For some time, I've been saying I think that bond yields would have a problem at the secular downtrend line, like something like the 10-year yield, and that we were probably going to have a kind of a bear market or a trading range in yields. And right now, we seem to be experiencing a kind of a counter-cyclical correction to that. So we'll see what happens there. Most important thing I'm concerned about right now, and I have been for the last month, I guess, is the relationship between inflation-sensitive assets, things like commodities, resource-based stocks, and deflation-sensitive assets such as bonds and things like utilities and so forth. Because that relationship is very, very finely balanced, and it's going to be very significant to see which direction it breaks out. And given the fact we've got some encouraging signs on the economy, it's more likely to break out on the upside, favoring inflation. But we'll get into that a little bit later. The dollar is trying to break out, but it's not firing on all cylinders, and so I'm kind of concerned a bit about this. You've got to pay attention or pay lip service to the fact that the dollar is in a bull market because it's above its long-term moving averages, and all the long-term momentum, such as the KST, is positive. But it's having difficulty breaking out to the upside here, and we'll kind of take a closer look at that. And that's obviously closely tied in with the commodity structure as well. And that's why I think we need to watch the Canadian and the Australian dollars for clues on the commodity markets, because as we see in previous roundups, there's a pretty good relationship between these two currencies and commodity markets. So let's take a quick look at some of the idea I had about the green shoots. This first chart shows the ECRI, a weekly leading economic indicator. And it's been around since the 1960s and has offered good leading tendencies for the economy, both on the upside and the downside. And you can see that from the fact that the red highlights represent recessions and the beige highlights represent slowdowns. In other words, when we get a growth rate on this indicator here, which turns out to be pretty high, comes down and never crosses below zero or seriously below zero, that tends to indicate a growth slowdown. And if we get a growth slowdown that takes place and a kind of a soft landing where it rallies before it crosses below into negative territory, that's a good thing. So the momentum indicator in the bottom, in the middle panel, is a price oscillator where we compare a 6-month exponential moving average to a 15-month exponential moving average. And that seems to be a reasonably good parameter to use on a lot of different economic indicators and on individual markets. It's not perfect. Nothing is perfect, of course. But I would suggest that sometimes you might want to take a look at something like that. So the idea here is that we've got these vertical lines which signal the end of, the red ones signal the end of recessions, and the beige ones signal the end of what I categorize as a slowdown using other indicators. And what you usually find is that this price oscillator usually bottoms out with the recession, or maybe a little bit ahead of the recession, and usually ahead of the end of the slowdown. So right now, what we're seeing is a uptick in this indicator. It's been upticking now for a couple of months, and it's crossed its moving average. You see the indicator, the RSI, in the bottom panel has also started to hook up. If we're going to see a recession, I would expect to see this indicator continue to move on down, and that's clearly not the case. It's now starting to turn up. That could be a false signal, like this one up here, for example. But generally speaking, when it turns, it means what it says, and I tend to go with that, especially if it's supported by other indicators. And that's what we're seeing in the next chart, which features another economic indicator. This is a chemical activity barometer. This is a composite leading economic indicator put out by the American Chemistry Council. And it's led every recession since I think it was 1912, 1920, something like that. A very, very long period of time, averaging between 2 and 14 months. Well, the good news there is that this indicator made a new high in April. And you can see that the oscillator down here, which compares a 1-month moving average to a 12-month moving average, kind of ticked up just before it fell below this red line here, which is what I call the recession line. Once again, the red highlights represent recessions, and the vertical lines this time represent the start of a recession. And you can see that every time we come down to this line and bounce, that typically signals the end of a slowdown. So right now, we've had a couple of slowdowns that have taken place since the previous recession in 2009. One around 211, 212, another one around 215, 216. And on each occasion, the oscillator came down, didn't go below the recession line and bounced. So we've seen the indicator again bounce from the point where it really should have done if we were going to avoid a recession. So that's positive. And of course, if we've avoided a recession, if that's a fact, then obviously that's got to be positive for the stock market. And going to the stock market, got the first indicator that has turned bullish. This is the S&P composite in this chart on the upper panel, and I'm comparing it to what I call my financial velocity index, which is a index which combines the rate of change of stocks, bonds, and commodities all into one indicator. So all three major markets, financial markets, are all included in this composite indicator. When it's rising, it indicates that in aggregate, these three markets are rising. So that means liquidity being pumped into the system. And when it starts to turn down again, that's typically spelling trouble for the stock market, because it shows that one or two or maybe even three of these markets are not managing to grow as fast as they were, and that becomes a negative factor. Well, I'm concerned here with the positive factor when the indicator comes down and starts to turn up, because when it starts to turn up, that indicates that lots of liquidity is being injected into the system, and enough liquidity to be consistent with a stock market bottom. And if you look at all these vertical lines here, all the green ones, all the solid green ones, they are all followed by major rallies in the stock market, because the financial velocity indicator has turned down and started to turn up. Even in 1929 over here, because this chart covers 1900 to 1970. Even in 1929, or in fact 1932 at the actual bottom, this thing started to turn up, giving a very timely signal. You notice there are a couple of vertical lines that are dashed and they're red. Those are failures, and you can see here that the indicator bottomed out, but the bear market had a little bit further to go, and the same thing here in 1940-41. So that was the history of this indicator from 1900 to 1970. And the next chart shows us from 1970 onwards. And you can see that in the last month, this thing has begun to tick up a little bit. Now, you may say, well, that's not much of a reversal. But when you go back and look at all the previous reversals, there are very few instances where you get a hesitancy and then a reversal to the upside. Usually when it reverses to the upside, it becomes a valid signal. And so we've had, since 1900, we've had 33 signals, only 2 of which were false signals that we saw in the previous chart. So here again, as I mentioned before, my stock barometer has gone bullish, which is a consensus of several different indicators. And this indicator now, which is not included in the stock market, is also turned to the bullish side. The next chart shows inflation-adjusted stocks in the top panel, and underneath is a Shiller price-earnings ratio related to the 10-year yield. In other words, what it is, it's representing current yield on stocks relative to earnings compared to current yield on bonds, interest rates. So when it's rising, that means that investors are favoring stocks over bonds, or the yield on stocks is superior to that on bonds when you look at the earnings side of it. And that tends to be bullish for stocks. And one way of measuring this is to look at the long-term KST of the ratio. And when the long-term KST of the ratio turns up, that's when we get one of these green vertical lines. Altogether, we've had 25 vertical lines, 22 solid green, which, like in the previous chart, indicates a positive, valid bullish signal. And then we've seen 3 failed signals, like this one here back in the 1960s, and this one over here around 1980. And then once again, we saw what I call this a failed signal here. I know the market didn't go down; it sort of went sideways. But I'm looking for the market to improve. So I call that a failed signal. Maybe it isn't, but it didn't last for very long. Now what we're seeing is the indicator in the last month has started to turn up and cross above its moving average to give us the 23rd signal since the 1930s. So there again, none of these indicators are perfect, but they do put the odds strongly in your favor when they go into a bullish mode. So what we're seeing now is a bullish signal from this indicator and the financial velocity and on the stock barometer. So all these things have turned bullish. And unfortunately, as you and I were discussing earlier, Greg, it's happening at a time when sentiment has also got bullish. So from a contrarian point of view, it kind of there's a little bit of a conflict here. You've got something like Ned Davis's daily sentiment indicator, for example, has gone right back to its 2018 high. So we have to be a little bit careful of that. And that's probably what suggests to me that we are overdue for a correction. I'm not forecasting it's going to happen because in a bull market, overbought conditions and overbelief conditions don't generally result in serious declines because you are in a bull market. So that's something to bear in mind. But generally speaking, I pay more attention to these longer term indicators. Now, maybe they're going to be false signals. I don't know. But right now, based on the accuracy of the signals in the past, I've got to go with those signals and say, they've gone bullish, therefore I got to go bullish, and I can't worry too much about the short-term stuff.
Yeah, if anything, using the short term as an advantage to buy into a bigger position. Yeah.
Yeah, and one way we can overcome that, of course, is to take a look at the same 2 indicators, inflation-adjusted stocks and the Shiller PE to 10-year yield ratio, and you can see that occasionally it's possible to draw some nice trend lines. When those trend lines get violated, you get some pretty important signal or reversals that take place. And it can do this on several occasions. That was a sell signal. Here's a buy signal that took place in the early 1980s. Then there's a sell signal, which wasn't particularly good because it occurred pretty well at the end of the 2002 bear market. But nonetheless, it usher into a period of sideways, basically a sideways period in the inflation-adjusted stocks and a sideways period for the ratio itself. And then we have 2 trend lines that were violated to kind of signal the new secular long-term bull market. And then right now we can draw another couple of trend lines. So as long as those trend lines are intact, I'm going to assume that the buy signal we got from the KST is going to be a valid signal. So that's one of the ways in which I'm looking at it. I'm kind of nervous about the sentiment being bullish, but I have to go with the long-term indicators. I know in the past, that's really been the area in which you really want to focus. So the next chart I'm going to show you is another indicator which has gone bullish, and this one monitors. This says the short-term KST, but the next indicator is actually going to monitor the long-term KST for a basket of, I don't know, 20 different S&P groups to figure out where their long-term KST is. In other words, what I've got here is 4 positions in which the KST can be. It can be in the fall position, where it's above 0 and falling, and that's a negative position. It could be in winter, which is about as bad as it can get, when it's falling below 0 and then starts to turn up. Or it can be in the spring position, where again that now becomes the first positive position for the KST, or any long-term or any momentum indicator come to that. And then the market phase is what I call summer. So the next indicator is going to monitor a basket of S&P industry groups where the KST, as at the end of April, was in this position here, either in the spring or in the summer. But in either case, the long-term KST was in a rising trend. And so now let's just take a look at the indicator. And here it is. And you can see that the number of groups moving into this position of either the spring or the summer is increasing, and that's at a pretty low level. Now, the other thing to bear in mind is we've got some green and red vertical lines. The green vertical lines indicate when the indicator reversed and it was followed by a worthwhile bull market. When I say worthwhile bull market, I'm talking about something like at least 6 months to justify it as a valid signal. Once again, the red dashed lines represent the false signals. As you can see here, we got a false signal in 1965. And then the latest false signal we had, I guess, was 2017. Although once again, the market didn't immediately fall. It did later on in 2018. So it wasn't that bad a signal, but I wouldn't call it a successful signal. Anyway, the fact is that we have a lot of groups moving into this position of either the spring or the summer. In other words, where their long-term KSTs are rising. And that becomes a bullish factor until it peaks out at somewhere around this level here or that level there and starts to turn down. So there's another indicator that's turned bullish. So the final chart we're going to look at this on the stock market takes a look and looks where all the various sectors are, because by looking at seeing where all the various sectors are, we can get a better feel for the underlying structure of the stock market. So this grayish bell curve here is a theoretical KST, long-term KST. And when I put, the other thing is to go back, recap, and then show you these various stages: the fall, the winter, the spring, and the summer. So obviously, what we would like to see in a bull market is for a lot of groups to be over here and few groups to be over here, because this is the market phase and this is the bearish phase for those particular groups or sectors. So right now, when we look at bonds, this is where bonds are. Bonds are in the early phase of a bull market. Now, when I say the early phase, they could turn over at any time, but when it's down here, that does suggest that it's got the potential to move higher before it gets into an overbought condition where we'd expect it logically to reverse to the downside. Industrial commodities are over here, just a little bit below zero, but they're in a position where they're bearish, but it wouldn't take much in terms of upside action to maybe reverse it to the upside. So right now you have to take them as bearish, but they have the potential to reverse. Stocks are up here, and what I've done here is I kind of drawn a little branch here, because what's happened to stocks is that they have started to go flat. That uptick there may exaggerate where the position is, but I wanted to point it out because a lot of sectors have moved from being over here to being over here, which is now where I'm putting the S&P. So if it starts to move up a little bit more, you'd have to transfer it from the fall position to the summer position, which gets a little complex. But it's a higher risk signal than if it goes from winter to spring. That's the natural way. But sometimes you get a market that doesn't correct as long as it normally would be expected to correct, and it moves from a fall position to a summer position. So let's take a look at some of the cycles, some of the sectors. So we're going to look where the red arrows are the ones which tend to happen early on in the cycle. They tend to be deflationary sensitive sectors. So we're looking at things like telecom, interest-sensitive home builders, staples, REITs, electric utilities, and so forth, consumer discretionary. And what happened in the last month was the consumer discretionary moved from over here coming down to over here starting to turn up. So they moved from fall to the summer. So it's kind of like a quick reversal into the bullish camp from the bearish camp. They don't have to go through all this time period of corrective activity. So it becomes a bit more of a high-risk signal, but usually these high-risk signals still work out on the upside. But the problem is, of course, that they move over here, and then they're obviously much closer to an overbought condition than, say, something like the home builders, which have just gone from winter to spring. And now we do the late cycle leaders, and so you can see once again that some of these indicators are sectors like industrials, semiconductors, materials. They've all moved over from the fall into the summer. But we still have a number of sectors which are still in the fall. So again, that probably means that we may have to see some corrective activity while these sectors come down and then become in a position to move higher. Or alternatively, you might see if it moved higher, of course, a lot of these could easily move over here, because biotech, for example, is bearish right now, but it wouldn't take much to turn it to the upside and move it over here next to materials, or between materials and electric utilities. So right now, I showed this chart in the last month, and we've seen a lot more stocks, or sectors I should say, move over here into the bullish camp, which again supports the idea that the market is in a bullish phase. Now we'll move a little bit on to commodities and the relationship between commodities and bonds. This is my global indicator of commodities against bonds. And when it's moving up, it means it's favoring commodities over bonds, and it's inflationary, and you want to be investing or trading on the side of the inflation-sensitive assets. And when it's coming down, that means bonds are beating commodities, so you want to be on the deflation side of it, emphasizing in your portfolios things like utilities and REITs and consumer staples and so forth. Well, obviously, looking at this chart here, you can see the ratio between bonds, between commodities and bonds, is getting to be approaching the moment of truth, because it's getting into an ever narrowing trading range. The other thing to note is that when the KST of this relationship starts to turn up, that's when we get one of these green vertical arrows. And when that happens, typically you get a move towards inflation, and a decent move at that. Sometimes it's not that decent. It becomes more of a sideways one, as it was in 2014. But we had a very positive setup for commodities developing, and they just never followed through on the upside. But most of the time, you get a nice run on the upside when that KST of the ratio starts to turn. Right now, it's below zero and falling, but it seems to be falling at a slower rate, just very slightly at the present time. And the indicator in the bottom panel, which is much more sensitive, as you can see, is just started to move up and cross above its moving average. It's just kind of anemically there. I wouldn't call it a decisive crossover yet, but it does kind of look like this indicator wants to turn to the upside. And if that's the case, it's usually an early bird indicator for the KST, because that's a less sensitive indicator. So if that's the case, the next thing we should be looking for, well, first of all, we should assume we're in a bear market or a deflationary trend, because the indicator is below its 24-month moving average, and the KST is still declining. But it may be getting to the point where things are changing. And as you can see from the fact that the US indicators, this is the global indicator here, but the US indicators, the economy I showed you earlier, the ECRI and the chemical activity barometer are both starting to turn to the upside. That argues in favor of commodities, the next major move in commodities being up rather than down. So they have, but at the moment, their short-term stuff, which we'll look at when we get to the stock charts platform, is starting to turn down a little bit. So that may mean that we're going to have a little bit of vulnerability in commodities over the near term. But it looks to me like the longer-term picture is starting to set up for a potential, and I emphasize the word potential, turnaround to the upside. So here actually is the global commodity index, and as you can see, it's again getting into a narrowing trading range. It broke below this uptrend line here going back to 2008 very temporarily, and now it's trying to struggle back above the line. It's right next to its 24-month moving average, and it's below this very important trend line here. If it ever gets above this trend line here, to me that will signify a very important bull market in global commodities. The other two indicators that we saw in the other chart are in a similar position, with the KST being down and the price oscillator starting to turn up. And this price oscillator is slightly above its moving average. So it's very similar. The commodity structure is not that dissimilar from the commodity bond relationship we saw before. So the 14.3 here, I should just recap, refers to the fact that there have been 17 signals, 14 of which we've got green arrows, green vertical lines, and 3 of which we've earned failed signals with the red vertical line. So again, it's still in a bear mode, but when it turns, then that would suggest to me that commodities, because they're so close to this trend line here, stand a very good chance of breaking out to the upside. But that has not happened yet, and we can't predict it until we see the KST start to turn around and then a move across the red trend, the extended red trend line, and so forth. But we'll be following this in future market roundups. And then finally, this is the CRB Spot Raw Industrials. This is a dollar-based industrial commodity index, which I follow. Not that dissimilar from the world index because it has a big weighting in the world index. But I put this in here to show you the vertical lines are showing you the major lows in the commodity index. And if you look down here with the chemical barometer price oscillator, that's the indicator we're looking at before, the chemical activity barometer, that leading indicator of the economy. This is a price oscillator where it looks at a 3-month against the 24-month moving average. And you can see when the commodities bottom out, this indicator has usually preceded it or it's coinciding with it as well. So this indicator has now started to turn up, again, giving us, I hate to use the word hope, but expectations, I guess, that perhaps the commodity market may be in a process of reversing here. But we don't have those signals yet. It just looks pretty close. So now I'm going to move over to the StockCharts platform, and we'll take a look at these markets in a little bit closer detail.
I can see that one.
I don't think you can, because I just lost it.
Yeah, it just disappeared.
Yeah. But being fully technically conversant, I've got it. So I think you should see it now, right?
Perfect.
Okay. So here's the S&P Composite. I'm just showing you this because you can see here that the KST is kind of flattening here. And the S&P does not include dividends. So I put the what's that thing called? That sign, Greg?
Sorry, which one?
The sign.
Oh, you did it unadjusted. So by taking the underscore, you take the dividends out. But I don't think there are any dividends in the S&P. There's only dividends in SPY. So.
Oh, really? Okay, yeah. So it doesn't make any difference then?
No.
Okay. I put it up to show it's going sideways. And in the past, when it's gone sideways, it's usually resolved itself on the upside. Sometimes it doesn't. But the S&P is also running up. Remember, we were saying we've got these bullish indicators, and we've got the sentiment kind of offsetting that to some degree. And here we're seeing the S&P is running into resistance in the form of its extended uptrend line. So this is what I was saying before about the S&P, the KST moving from the fall position to the summer position. But we can look ahead and look and see some other indicators that have been pretty reliable and see what they're doing. where we're measuring price. Because remember, the KST is not as sensitive as we probably would like. But if we're looking at the PPO using 6 and 15 parameters, 6-month moving average divided by 15-month moving average, when it crosses this, when it comes down and either reverses at or below this blue line here, just a little bit above zero, that's when we get one of these green vertical lines. And once again, you can see that the vast majority of times when it reverses and turns up, we get a rally in the stock market of at least 6 months in duration. There have been a couple of failed signals like this one over here in 2002. But by and large, they usually get corrected fairly quickly. But by and large, when it's turned up as it has in the last couple of months, you're expecting to see a rally in the stock market of lasting at least 6 months or so. So that suggests to me that KST that we looked at in the previous chart, because this is a leading indicator, and it doesn't give that many false signals, suggests that KST is going to start to turn up, and then it will be in that summer position that we talked about before. So now we're looking at the S&P relative to two different asset classes. This chart here shows the S&P relative to the USB, in other words, stocks against bonds. It broke down seriously where bonds started to outperform stocks, and has then moved back above the moving average again, which is a 12-month moving average. So it's in a positive mood now. But one of the things you can see is that usually when it experiences some kind of a bear market, the KST is, for this ratio, is usually down at a fairly subdued level and doesn't have much trouble turning to the upside. In this case here, of course, it's still in an overall position and declining. So that's a little bit of a problem for the relationship, but I take the fact that it's above its 12-month moving average and the trend is positive, along with those other positive indicators, treating this whole thing as a positive mode. Now, next chart shows the S&P composite in the upper panel, and underneath is a KST of the ratio of stocks to commodities. So when it's moving up, it means that stocks on a momentum basis are outperforming commodities. And when it's moving down, it means stocks are underperforming on a momentum basis, they're underperforming commodities. Bottom line here is that when the KST starts to turn up, that's when we get one of these green arrows. We've had 17 of these green arrows since this chart began in 1960. 16 resulted in positive results, as you can see all the way through here. So when stocks are outperforming commodities, that's usually bullish for stocks in their own right. There was one failure, and that was again in that 2001-2002 period. But all these others have been successful, and we have another signal here, which is given a couple of months ago, again pointing to the fact that stocks are likely to experience a bull market here. Next chart shows the S&P versus the copper price. And copper price is a kind of a proxy for the economy, because you find that Dr. Copper, as he's called, often signals ups and downs in the economy through the price structure of copper. And so what I've done here is I've got the S&P in the top panel, and underneath is the ratio of the S&P to copper. And when we get one of these green shaded areas, that shows you when the ratio is in a rising mode for an extended period, and it's above its 12-month moving average. And we can do this, obviously you can't do this in real time because you don't know how long the ratio is going to remain above its moving average, but you can look back and say, well, it was above its moving average for a long period here. And when it's above its moving average for a long period, what happens to stocks in the green shaded areas? With a few little exceptions like the 1998 correction, but a few periods, exceptions, it means that stocks are moving higher. And where are we now? Well, we just crossed above that 12-month moving average of the ratio. It doesn't work every time. There are no such things as perfect indicators. And here you can see we got a gray shading area, because the ratio was above its moving average for a fairly extended period, and certainly on a very certainly on an extreme basis here. But the reason why that didn't work out for stocks is, of course, stocks were falling, and the copper price coming out of a secular bull market was falling faster than stocks. So stocks were outperforming commodities, outperforming the copper price, but that was because both were falling and stocks were falling less quickly. So you have to watch that one occasionally. But right now, an indicator is bullish. You can also see the KST for the ratio in the bottom panel is also in a bullish mode. And so for the ratio, and when the ratio moves up, generally speaking, that's bullish for stocks. So it looks to me like you've got those economic indicators starting to turn. You've got all these momentum, velocity, financial velocity and stuff all turning. And you've got this kind of equity market, economic market, commodity market indicator also in a positive mode. Now, Greg, you asked me about the IWM in our last market roundup, and I passed the question because I haven't really been following the IWM, the low cap stocks very
It
much.
just sits there. Yeah, it just keeps trying to get through. It's 1600 on the index and 160 on the IWM. Yep.
Yeah, so you caught me blindsided there because I don't usually follow the small cap, large cap stuff. Which I should. So I thought I'd put a couple of charts up so that if you ask me again, at least you'll get some idea what I'm thinking about on this.
Ready. The one thing I noticed on this one, just standing back, is how weak the KST is in April. So.
Yeah, and you can also see that the RSI, when we got up to these highs here, and that was a new high, was not as strong as it was earlier.
Yeah.
If it goes with the breakout, then some of this stuff's going to turn out in the KSTs as well. But the reason, I guess, one of the reasons I haven't been following it very much is the relative strength hasn't been doing a lot. And that's what I've shown on the next chart here. It's the IWM in the top panel. Underneath is its long-term KST. And its relative strength to the SPX. So when it's going up, it means it's outperforming the market. When it's going down, it's underperforming. And then the long-term KST of the relative action. That's a KST of this chart here. So you can see why I'm not that excited about the small cap stocks is because they basically, relative strength-wise, they've been in a trading range. I mean, you could draw this line back to 2014, or you could start it here in 2016. It's really not. It's not been going anywhere, and I like stuff which is going somewhere. Now, having said that, of course, it may start to go somewhere because it's down at the lower end of this trading range, and the KST for relative action is a little bit below zero, so it could turn up at any time. But really, there's nothing there in terms of upside breakouts that gets me excited about this sector of the market. So that's my belated answer to your question. What I think about the IW. I don't know if you disagree or what do you think?
No, I agree, but I think the bigger issue, it just seems like everybody's piled into the large caps index following, and these small caps are getting pushed. Not lower, but there's just no bid for them either. So, yeah.
Yeah. So let's here, this chart here is something that developed in the last month. Not decisively, but it looks kind of interesting. This is and I wrote an article about it, I think last week. The ratio between the SPY and the MSCI Europe, Australia, Far East Index, which is essentially the S&P versus the rest of the world. So when this thing is moving up, it means the S&P is outperforming the rest of the world equities and vice versa. It had been in a trading range for a while, and now it looks like it's breaking out the trading range on the upside. And it also is being supported by the short-term KST, which is trying to go bullish. Well, it is right at its moving average right now, but it's kind of hooking up. And the intermediate K is definitely bullish. It's above its moving average here. So that's not to say that this isn't a full breakout, but I'd much rather have a breakout occurring when it's supported by rising short and intermediate momentum as this is. So that suggests to me that this relationship's going higher. And one of the things about this relationship is when it moves up, it tends to be occurring under the context of a rising dollar index. We'll take a look at that a little bit later. Right now, we're going to move on to bonds for a couple of charts. This is the TNX, the 10-year. This chart goes back to 1970. This is a secular down trend that took place. And it experienced a false move above the trend line, and now it's started to move back. And you see that the KST is also in a negative mode, and it's also broken this sharp uptrend line here. So the question is, where does it go from here? Because my feeling is that, well, certainly in the past, when we've seen a reversal of the secular trend, like an uptrend here, it's been associated with a kind of a price pattern extending over many years, where you had the yields coming up and then a battle between buyers and sellers for maybe 5 or 10 years, and then the sellers win as the yields come down. So I'm kind of looking at the same thing to repeat itself, not exactly as it did at the top or as it did in the previous bottom, but to experience, for the yield to experience a trading range. And once that trading range is broken out on the upside, then we can categorically say that the chances are that that secular downtrend in yields, which began in September of 1981, has reversed to the upside. So I think what's happening here is this downtrend that's taking place is all part of a base building process. I would be very surprised if yields went to new lows, but I would not be surprised to see them come down to the 10-year will come down to the 2%. I wouldn't be surprised to see it sort of flap around here and not experience any more of a decline, but just extend that trading range. Here's a more up-to-date period. And here is this is again a 10-year yield. Here's the short-term KST here, and the intermediate KST right here. The short-term, excuse me, it started to turn up, and that suggests to me that we may get, I know it's pretty strong today, but in terms of prices, but we may get a little bit of a backup in yields that take place here as part of this corrective process against the secular trend. I'm less convinced of that now than I was around this period here. I began to get bearish on yields around here. It was obviously a little early because we had one more move up, but I'm less bullish now on bond prices than I was at this point just here, or bearish on yields because we're looking at a yield chart here. Apologies for that. So let's move to the next panel. And now we're looking at the commodity markets, because we've got this very fine balance between commodities and bonds, which I think is taking place. So in the upper panel, we've got the CRB composite, and underneath is the what I call the Pring inflation deflation ratio, which you can plot by plotting the exclamation mark PRII against exclamation mark PRDI, which stands for PR inflation index, PR deflation index. This is a ratio comprising sectors in the stock market that are sensitive to inflation or commodity prices. So on the inflation index, we've got things like oil stocks, oil sectors, the oil sector, and we've got mining and so forth. And on the deflationary side, we've got early cycle leaders like REITs and the consumer staples and utilities and so on and so forth. So when it's rising, it's favoring inflation. When it's falling, it's favoring deflation-sensitive stocks. And as you can see, the ratio, what the stock market's saying, often jives with what the commodity market is actually saying, except that you can see that a lot of these arrows here go from a peak in the ratio to a peak in the CRB composite, indicating that for the most part, the stock market leads what's actually happening in the commodity market. It doesn't happen on every occasion. Here at the 2008 peak, it was more or less a simultaneous reversal. But generally speaking, most of these arrows, green being bottoms and red being tops, translate to the right a little bit, suggesting that the stock market has a slight edge in terms of forecasting what's going on in the commodity markets. Well, right now, you can see that both of these series have the potential to be forming bases. Here's a top for the potential top for the CRB, just a little bit under the 200 area. and then the ratio itself is below this trend line here and below its moving average. So the trends right now, both commodities and stocks, long-term trends, I regard as being negative. But it looks like it's tired of the ratio. At any rate, it's tired of going down. We'll find out if it approaches this low here and then exceeds it. That will indicate to me that that's giving us a leading indicator on the stock market that the commodity prices are going lower. And certainly the KST is, for the ratio down the bottom panel here, is falling, but it's not falling that much. So it's going to be interesting to see how this plays out. We'll follow it in future roundups.
Just one more thing on that. One of the things I'm starting to notice is, stock charts like ConocoPhillips breaking a 3-year trend line in the last week or two. Just starting to see some of the big oil names, even though oil's still way up there, they're breaking 3-year trend lines here. So it's quite odd to see that.
Yeah, that's one of the reasons I was saying earlier that the balance between inflation and deflationary forces is very finely balanced. And so you get all these contradictory signals.
Yeah, it's definitely a fight out there for which way that's going to go.
I mean, as someone like you and I who deal in probabilities, that's not nice. We like it when all the probabilities are 20.
When the ducks line up, yeah.
Right. But that's the hand we're dealt, so we've got to play it and look for the idea that the places where that impasse is likely to be resolved. And in this case here, in this chart, it will be a break above these two trend lines here. So this is the DBC, the DB commodity ETF. Yeah, it's an ETF, not an ETN, right? And it has just broken this trend line here going back to the beginning of the year. And it had a real problem getting through its 200-day moving average, as did the Bloomberg Commodity Index. It actually went through on a more decisive basis, but they're both back below their 200-day moving averages, which kind of suggests some near-term weakness. And then this is the inflation-deflation ratio we looked at in the previous chart. You can see it's definitely was in a tight trading range. And I mentioned in previous roundups that I'm kind of watching to see which direction it breaks up. And it's obviously broken out decisively on the downside. So that, again, suggests that the ongoing deflationary trend is likely to continue. And then another indicator, which is, again, a stock market indicator, this is where we take the Goldman Sachs Natural Resource ETF, the IGE, and divide it by the consumer staples, the SPDR consumer staples, the XLP. Once again, when it's rising, it's indicating that the IGE is outperforming the XLP, and that's usually associated with rising commodity prices. Bottom line is that this indicator too, which kind of acts as a check on my inflation-deflation ratio, is also broken to the downside. So that all suggests that commodity prices are headed lower in the immediate future. How much time do we have left, Greg?
We got about 10 minutes, Martin.
10 minutes, okay. Thank you. So here's the Bloomberg Commodity Index I referred to earlier. It's just another way of looking at the same kind of thing. It is broken just like the DBC is broken. It's this uptrend line. But I put it down here because we have two net new high indicators which StockCharts calculates for us. One is it finds out the number of commodities making net new highs over a 10-day period, and the other does the same thing over a 50-day period. And you can see that while we've broken below this trend line here, these two indicators both are fairly close to an oversold condition. I mean, there's nothing to stop them going much lower, but it would suggest that the short-term decline here has run most of its course. Now, you never know that until you can obviously see a reversal in the momentum and so forth, and a reversal in the price trend. But it does look like this is a little bit overdone on the downside, and probably could be a little bit more overdone on the downside before it starts to reverse. So again, it suggests to me that we're going to get some near-term softness here in these commodities. And if once that initial softness turns, given the fact that the economic indicators are starting to turn, there's a good possibility that commodities themselves will experience a reversal to the upside. And one of the things I would watch would be this this ratio here. This is the CRB composite, and underneath commodity index, and underneath is a confidence ratio, and it's a confidence ratio known as a bond spread, where we compare the high yield bonds, the HYG, iBox high yield shares, and they're divided by the 10-year, the 7 to 10-year government ETF, the IEF. And the term I was looking for before was underscore. So we put the underscore in front of these so we don't have interest payments or dividends showing up in the calculation. It's a pure price calculation. Because obviously, if we're looking at high yield against low yield, and we include the dividends on a total return basis, we're going to get an upward bias on the high yield shares. So that's why I like to reduce it to just the price by putting the underscore in front of these two symbols. So when the line is rising, when the ratio is rising, that means investors are gaining in confidence because they're bidding up the price, relatively speaking, of the high yield shares against the governments. And when they're losing confidence and they feel that there's some defaults in the air, then the traders go for safety, and so they go for the IEF or go for the treasuries. As you can see with these arrows here, the two series move fairly closely together. So the bond yield can be said to be moving up and down on confidence. So this is something I'd be watching very carefully as to what happens to this ratio here, because if it starts to break to the upside, that would suggest that commodity prices will too, and vice versa. So here's the ratio again on its own with a short-term KST. And the KST has started to turn to the upside. Not quite bullish yet above its moving average, but the intermediate KST is. And the long term is still undergoing a bear trend. But you can see it's around zero. So once again, it wouldn't take much to reverse it to the upside. So it suggests to me with this momentum combination here is that this is the time when we should be watching this ratio very closely. Because if the two short-term KSTs start to move up and the ratio itself can break above the dashed line and the solid line, that will be a very powerful signal that the commodity markets had reversed. The other thing to bear in mind is that would also, in all likelihood, reverse the long-term KST. And I don't have it with me today, but I can show you when the long-term KST of this ratio, or similar ratios, because we don't have the history of this gone back that far, similar ratios starts to reverse to the upside. That is associated with a bull market in commodities. So it hasn't happened yet, but it's something I'm going to be watching in future market roundups. But I think I better stop here, Greg. I'm sorry I didn't get the Canadian dollar, but next month perhaps.
Well, actually, your next chart is US dollar. We still got a few minutes, so let's cover that off. The one thing I will say before you move on is on your intermediate KST, one thing I always like to watch for is a rollover below zero. So, back in 2015 in May, June there, it rolled over right at zero. And that's always an important inflection point to me to see which way it wants to go. So this coming up from the bottom, bouncing, approaching zero is always a highlight real place to watch for, because if the market's going to change, this is where we'd usually see it. Once it starts to get the confidence to actually move into positive territory, that can help a lot. Conversely, if it rolls over while being under zero, it's really an important place to watch for bigger trends that might initiate a strong move down.
Oh, absolutely. And as you can see from here, after this close to zero rollover, we got an above average decline that followed.
Yeah, so it's a pretty sensitive spot, and we are making lower highs on that chart already. So
we're seeing the same thing here, where you got this reversal with just above zero.
Yeah,
actually made a new high. It was actually stronger here than it was there.
Yeah,
and it's been followed by a sharp decline, but it looks like that decline maybe truncated. I don't know. But
we'll find out.
We'll find out, as we always do.
What do you think about this U.S. dollar?
The U.S. dollar. Okay. Well, here's the U.S. dollar index and the special K, and it's broken above the special K, but it's also, and it's above its signal line, which is a positive pattern, and the KST is positive. So if it's going to break above this green trend line, it ought to do it in fairly short order. Otherwise, all this stuff is going to start to roll over again. It's actually on a UUP, as you pointed out to me, I guess earlier in the week, the UUP is already broken out. That's the bullish dollar ETF, and but I would prefer to go with the index itself because I don't have a lot of understanding of this, but it seems to me that the ETFs have a lot of derivatives in them, and those things change their price points quite a bit in terms of value and so forth.
Yeah, I think one of the things I on this dollar, I'm in the back of my mind is the Martin quote where when things make a false breakout to the upside and then reverse, you usually get an above average move to the downside. And what you see there in the beginning of March, the dollar briefly broke above the previous highs from October, November, December, and then all of a sudden rifled all the way back down to the bottom of the range. And here we briefly made it to a higher high and now starting to unwind. So we're about to find out which way this dollar wants to go. And I think the Fed move this afternoon is probably going to be a bit of a spark plug. I've got a chart where I keep the US dollar and the Fed meetings, and there's some serious reversals that happen on Fed meetings within the US dollar. So I don't know if that's going to happen today, but I sure know I'm on the watch for it. And usually today isn't the right answer. It's kind of like, what's the trend on Friday? Which way does this thing seem to be wanting to move? So
Yeah,
let the echo of the Fed meeting get finalized, and then we'll have a sense of direction. But I noticed I use an MYI, a municipal bond fund, to try and help me on the 10-year, and it's still pointing higher prices, lower yields, which surprises me. So I know the financials have been the strongest performer last month. They were up 9% on the month. So with that kind of a backdrop, you would think that it points to higher yields, lower bond prices, bigger spread for the banks. But that financial sector has been the single biggest performer last month, even with all of these great tech earnings that have come out. So it's quite a surprise to me. The market's really been complicated here with the bond yields not moving in the direction I would have expected them to.
yeah, I think that's right. Looking at this chart here, though, it would seem to me we got two points to monitor. One's 98, where the green line is, and the other is 95.89, where the 200-day moving average and the red trend line are currently
Yeah.
residing. And that's going to give us point us in the right direction now.
Yeah, I think those are critical. I had 97.50 as a big line going back 20 or 30 years for the US dollar. So it's one of my lines in the sand that I'm specifically watching. But I keep thinking, is it the bond market that's pushing the dollar around, or is it the dollar pushing the bond market around? And with the strong US dollar, does that bring more money into US bonds? Because of course, foreign bonds yield almost nothing. So it's quite an interesting situation.
Yeah.
And then, Martin, the last thing I've got for you is we didn't get a chance to talk about gold. We got just under a minute left, but I wondered, do you have any brief thoughts on gold? Is it still just a sideways market, or what do you think?
Well, it's a sideways market until it isn't, I guess. I was doing a review for my monthly publication yesterday, and the long-term position for gold on momentum and so forth still looks positive, and the shorter term doesn't look quite so positive. So we've been in a big trading range here, and until we break out one way or the other, it's kind of problematic. And I think I'm correct in saying that sentiment for gold is fairly bullish right now. So that complicates things as well. So I don't have I guess I'm hedging my answer here, not really giving you one, Greg.
Well, that's all right. Hey, Martin, I want to thank you for taking the time to join us. Another great session with lots of good charts in it. Thank you once again, Martin.
Thank you. Thanks for viewing.